Amazon's Q1 numbers are in. Is it enough to push Amazon back up over 52-week highs, all-time highs, over $190 per share? Or is this stock headed lower? We'll talk about that on today's show. What is going on, investors? Hopefully you guys are doing well out there. If you've owned Amazon over the last year, you've done well, up over 71%. And even year to date, Amazon shares up over 15%. The company reported their Q1 earnings revenue, $143.3 billion. We won't just gloss over that. It's over $100 billion. Now we're approaching $150 billion. I remember when we were doing these videos when they were just eclipsing $100 billion. Now we're up over $140 billion. That was 12.5% growth year over year. Wall Street was more or less expecting that. The high end was about 145. The low end was 138. So the company did a nice job coming in slightly ahead of expectations. I tell you what, when you've got over $140 billion worth of revenue, plus or minus $1 billion, actually isn't a whole lot of money. Now, second quarter guidance, actually a little light for Amazon, expecting revenue between $144 billion up to $149. The consensus was for $150. The low end was $146. The high end was $152. So the low end, over $2 billion lower than what Wall Street had on its low end, and the high end at $149, even if you assume Amazon beats next quarter, which they probably will, even closer to $150 billion. At best is meeting expectations, and it's a couple billion light of the high-end expectations. I don't necessarily think this brings into any questions for subsequent quarters in terms of readjusting some of these revenue targets. When a company has lower guidance, that is something that you have to worry about. But I think we're low double-digit, maybe 10%, high single-digit growth for Amazon. I don't think that's necessarily in question. Now, what's also not in question is the fact that this company over the last year, especially under Andy Jassy, has impressively grown their operating income, operating cash flows. You are going to see this company went from being marginally profitable to now being wildly profitable. $143 billion on revenue. Last year, we were at $127. Cost of sales is going to tick up in an e-commerce environment, first-party retail. Your fulfillment costs, though, went from 21 up to 22.3. Seems like they're keeping a lid on those costs. Technology and infrastructure, basically flat year over year. Your sales and marketing, we saw this at Google. We saw this at PayPal, actually, this morning. You're able to drive higher sales growth to the tune of over 12.5% in the most recent quarter. And look at what happened to your sales and marketing. You actually drove it down from 10.2 down to 9.7 on the marketing. You also drove down your general administrative from $3 billion south of $2.8 billion. That gave you total operating expenses going from 122 last year up to, I say, just 128. Look at your operating income from $4.8 billion all the way up to $15.3 billion, over $10 billion added to the operating income side. That means as you see this net sales growth, and look, we talked about how this company is likely going to grow their revenues 10% next quarter. Well, guess what? A lot of that revenue is now flowing down to operating income. This wasn't the case with Amazon really in its entire history. As it grew its revenue, its operating expenses grew as well. Now the company is churning out a profit. You flow all the way down to like EPS. It includes, I believe, like their Rivian investment, which can't be doing good right now. Also interest and other things, which is actually pretty typical. After you subtract those things off of $143 billion in revenue, you printed $10.4 billion to the bottom line. Last year, you were closer to 3.2. Now, more impressive than that, we've been talking about it for a while here on the channel. The North American e-commerce business, I think, is going to overtake AWS in terms of profit. I don't think anybody had that on their bingo card. Look at this. Last year, you made just $898 million, which again, to a company worth over $1.8 trillion, $898 million, while you and I would be set for life, Amazon, it's more or less a rounding error on their valuation and their revenues. But look at what happens over the last year. $86 billion in revenue. That's nearly $10 billion higher than last year. But look at your costs and expenses. They didn't go up nearly at the same place. So your operating income went from $898 all the way up to nearly $5 billion. We've talked about the international business as well. hasn't been profitable outside of, I think, a couple of quarters during COVID. You lost $1.3 billion last year operating that international e-commerce business. You didn't have revenues really explode from 29 billion up to, we'll call that 32, but your operating expenses stayed in check and you turned a loss into a positive, nearly $1 billion. So the total e-commerce business is now churning out nearly $6 billion worth of operating income in a quarter. Here's your AWS segment. Now, here's some things that are a challenge for Amazon. For over a decade, they were the clear leader in cloud computing. Well, things are changing. The cloud is different. AI servers and AI data centers are different. We're seeing Microsoft grow at north of 30% in their Azure data center business. And the conference call, the company even said they were seeing demand outstrip supply. Google is growing their Google Cloud business by exponential amounts. Well, we're not seeing that massive growth over at Amazon. They are a step behind in the race to AI. Doesn't mean they're getting left behind, but they are a step behind. We're seeing net sales go from 21 up to 25, operating expenses ticking down, believe it or not. Your operating income exploded from 5 billion all the way up to 9.4 billion on just 4 billion, even less than $4 billion more in net sales. Amazon doing an absolutely fantastic job controlling operating expenses. And I tell you what, if they didn't, this e-commerce business would be carrying this company, which again sounds absolutely nuts. Now, what's also nuts is when you come over here and look at operating cash flows for Amazon. You pull down a net income number. Last year was 3.2 billion. This year, an impressive $10.4 billion. When you got as much stuff going on as Amazon, you got a big depreciation charge, which is non-cash. You have to recognize that in these operating expenses. That comes off the books in cash flows. Stock-based compensation, that's not cash. That gets added back in. Some non-operating expenses, that gets back in. Look at your operating cash flow from 4.8 billion last year all the way up to $19 billion. Now, that would be impressive, but that's what this company has been doing over the past 12 months. Here's your 12-month period ended in March, $100 billion. So on average, $25 billion of operating cash flow per quarter. This company is set up with some cash flow. Now, what's interesting is we saw purchase property, plant, and equipment. I'm going to assume this includes AI data center, all the investment in the data center. We see Microsoft increasing theirs 50%. Google's increasing theirs rapidly, same pace. Meta announced a big increase there. Look at Amazon, keeping it under control. I don't know if this is good or bad. You've got other companies, other heavyweights coming into your territory in terms of the data center, and Amazon's not really incrementally investing there from 14.2 last year up to 15. In fact, if you look at it year over year, your investment on property, plant, and equipment went down from 63 down to $53 billion. That's given the company a massive cash balance infusion over the past 12 months to the tune of nearly $24 billion added to the cash side. I don't have the balance sheet of Amazon, but they have, I think, about $80 billion in cash balanced off by 50 some odd billion dollars worth of debt. Nothing really to see from the balance sheet perspective if you produce these big operating cash flow numbers. And as long as this e-commerce number continues to trend in this direction, even as they play a little bit second fiddle, if you will, in terms of AI data center build out, this company still has other business lines that will pick up the slack. Now, your online stores over the last year picked up 7%. That's strong growth, even coming in line with where you've seen in the Q4, which is obviously a big holiday shopping season. Your physical stores up 6%. That is staying relatively steady. Your third-party sellers, these are individuals that sell on Amazon. We're actually seeing that start to slip. Amazon implemented some fee changes on their platform, and so we'll have to see going forward. Does this impact third-party seller revenue going forward? Advertising revenue, boom, up 24%. A mid-20s grower for the past several quarters. That advertising business obviously comes with healthy growth margins as well. Your subscription business, this is Amazon Prime, that slipped in the most recent quarter. Could be the company is peaking out in terms of Prime penetration, or they need to just roll out more benefits to that Prime membership to get those people that haven't already subscribed up. AWS growth, we talked about how Microsoft was in the 30%, Google was in there too. 17% growth, which is a reacceleration over the last several quarters where you've seen 12 to 13% growth. So 17% growth there. And on top of that, that AWS business just absolutely blowing out of the park in terms of operating income and profits. Things are looking good for Amazon. Good enough to keep the shares where they're at. During the regular trade, they were down 3%. After hours, they're up about 3%, but not good enough, in my opinion, to power us up over the highs like you saw with Google, like we saw with Meta last quarter, where you have that earnings report that just completely surprises and takes people by the hand and just pulls them up. We didn't see that with Amazon. But at the same time, these results, these operating cash flows, the fact that the company is controlling their cost year over year, and they're coming at this with such high revenue. When you have 150, 160, $190 billion in revenue. This time next year, in Q4 of 2025, Wall Street's expecting a $200 billion revenue, not for the whole year. We're talking for a quarter. When you have that much revenue and you start controlling the cost, well, you are going to get a massive amount of money flowing to the bottom line, cash flows, operating income, all those types of things. So it's enough to keep Amazon shares where they're at. And in the shorter term, we are locked in this uptrend. Any pullbacks in Amazon can be acquired right now. Things are looking good, not great, but Amazon looking good enough. And we got to hand it to Andy Jassy. Came in after Jeff Bezos. He's controlling costs, making this a wildly profitable company. But now investors are going to start asking the questions, what's next? And will they completely get lapped by Google and, more importantly, Microsoft in AI? Amazon has some questions to answer there, and we'll see how they answer them in the coming months. Folks, we'll be back again later this week to talk about Amazon and our FANG Stock recap show on Friday. I hope to see you then. Until then, good luck with your investments.